Hi, I'm James Robinson, and this is my stock pick of the week. So I'm coming to you this week from Flagstaff, Arizona, where I'm doing a little weekend vacation. So hopefully you enjoy the trees in the background and you don't mind a little bird chirping and some wind. This is the third of the series. I'm doing, this section is going to talk about the balance sheet for Cisco. The first thing we're going to talk about with Cisco is, in terms of the balance sheet, is cash and marketable securities. Again, this is simply money that the company can virtually instantly get their hands on, and that's important because it gives you a sense of the company's stability, their ability to withstand things that are going wrong. And you can see what might at first look like an alarming fact. The company had amassed about $7 billion in cash, which is great, and then in the last 2 years, it's gone through about $4 billion of that has been spent. And normally that would say, well, wait a minute, why are these guys losing all this money? But as you'll see later, a bunch of that money went to pay off debt. They bought back shares, they paid dividends. So what they've done is they've simply decided we have more cash than we can use and more than we can justify. And so we're giving that money back to the shareholders. We're creating wealth for the shareholders by buying back stock and paying dividends, and most importantly, by paying down debt. So I have no concerns or no issues with this cash flow situation, this cash and market security situation changing like it did. In fact, I'm actually pretty happy about it. So the next thing that I like to look at is current assets in relation to current liabilities. Now, current assets is not the same thing as cash and marketable securities. Current assets is money that the company expects to get its hands on within a year, so it includes a lot of receivables. And current liabilities are monies that the company expects that they will owe in the next 12 months. And what we'd like to see is a gap between current assets and current liabilities, which means you have a buffer, right? In this case, the company's buffer, as you can see, just got bigger and bigger and bigger until the company finally said, well, this is silly, and decided to pay a bunch back to the shareholders. But again, even though they've paid back a bunch of money to the shareholders and paid off debt, they still have a significant buffer zone between the current liabilities and the current assets. So that shows you the strength of this company, and it shows you that the intelligence of the management and that the management looks out for our shareholders. Rather than starting looking at the balance sheet and focusing on debt, the only reason debt really matters is because you have to pay interest on all that debt. And the interest that you pay is an obligation. It hurts your operations, it hurts your profits. But more importantly, the interest is the thing that can get you in trouble when the situation gets bad, because you can't not pay it. So I like to look at, when I look at the company's debt, I like to say, well, how does that debt really manifesting itself? What is the interest obligations? And more importantly, how are those interest obligations in relation to the company's operating income? So the first slide here is you see interest expense, and then you see interest income, and you see the net expense. So the good news here is this company has historically made more money in interest income than it's paid in interest expense. So when I start talking about the debt the company has in a few minutes, keep in mind that they make more money in interest income than they're paying in interest expense. So the debt's almost completely irrelevant. There should be no problem with this company's ability to make its interest payments. Secondly, when you look at it in terms of scale, I like for interest expense to be no more than 15% of a company's operating income. And then you can see with this company, it's roughly 5%. So it's a non-issue. So there's two different reasons why when I talk about the amount of debt this company has, and it's in the billions, that it's really not that significant amount of money for a company of this size, a company with this kind of operating income, and a company with this much interest income. So when you add all that up, you basically say this company's balance sheet is effectively it's not a 10 out of 10 because it does have debt, but in terms of its impact on income, it's a 10 out of 10. This is looking at the company's debt analysis. The blue is total current liabilities. You'll oftentimes see companies' total current liabilities going up every year. In fact, you almost expect and hope to see that, because if you're growing your business, you're going to always have more employees and more office space and more factories and more equipment and more things you need to buy and more things you need to pay for. So that number's going to go up and go up consistently. What you would hope is that it goes up less quickly than the income and less quickly than revenues. Your debt itself oftentimes goes up in lockstep, but what you'd like to see is the company's debt start to get paid down as the company starts to make more and more profits. And so you can see here, that's almost exactly what's happened in this company. In 2005, this company's total current liabilities have gone up virtually every year, but not crazily. And it's gone up with debt. So what's happened is the company has used debt to fund its growth, right? But now what's happening is the companies, all of a sudden, if you look at the debt in the last 2 years, the debt, the total long-term debt has gone from about 25 billion to about 14 billion. And all of a sudden there's this thing where you see current liabilities continuing to go up, which isn't necessarily a bad thing, but you see debt starting to go down. And that shows that this is a strong company with strong cash flows, and it gives us really good comfort that this is a solid company we want to own. So we've talked about interest coverage ratio, and without getting too in depth in the weeds, interest coverage ratio is simply the ability of the company's income and operating income to more than pay the company's debt. And I like to see an interest coverage ratio of 3 or 4 times. And I like to see 3 or 4 times the amount of income coming in as I need to pay my debt. So for the sake of conversation, $4 of income for every dollar of interest payment. In this case, you can see this company is consistently 15 times. So again, this company makes plenty of money to pay its debt. And again, remember that debt number in this analysis is the actual interest expense, and that number is not the net interest, which is including the interest income. So if the company stopped making money off of its finances and stopped having interest income at all and just had the interest expense that it currently has, it would still have 15 times the income that it needs to make its debt payments. So again, debt for this company, even though it's $14 billion, is sort of an irrelevancy. Another thing that I like to look at, which gives us a context and allows us to quickly decide how significant this company's debt is what I call year's income to pay off debt. So how many, if we stopped taking all profit and gave it to the shareholders and did nothing but pay off our debt with it, how many years would we have to do that before we'd be a debt-free company? And you can see this company has been at about 3 years, which is great. I like to see 4 years as sort of my threshold. Now you're going to see that in 2018 I took that number off the graph. That was because in 2018, for reasons we don't need to get into now, this company had a bad year and only made, instead of making $10 billion in profit, they made 100 million or something. And so that number was off the charts. And the problem is it made the rest of the scale hard to see. So I just deleted it because it was a one-time blip. And so you can see that there's a dot there in 2019. The graph doesn't continue to 17 and 18. Trust me, it's not a big deal. But the good news is in 19, we've gone from 3 years to less than 2 years, actually a year and a half, income to pay off all of our debt. So everything about this company is just stronger and stronger. So that's it for Cisco. Not much else to talk about in the balance sheet. It's obviously very, very strong. Hopefully you like this video. Hopefully you subscribe. Hopefully you click the like button. And if you want to follow me on Twitter and see what I'm doing in real time with the stocks, my handle is @robinsonstocks.com. I'm sorry, my handle is @robinsonstocks.